In the 1600s, the Dutch East India Company sailed hundreds of ships across the world, trading in gold, porcelain, spices, and silk. But financing these massive global ventures wasn't cheap. To cover costs, the company turned to everyday citizens, offering them a chance to invest in a voyage in exchange for a share of the profits. This simple exchange sparked a revolutionary idea: raise capital by selling ownership. Soon, these shares were bought and sold in coffeehouses and shipping ports across Europe. Without realizing it, the Dutch East India Company had created the world's first stock market. Since then, companies have relied on investors to fund ideas from sailing ships to software startups. Today, the stock market powers entire industries, fuels innovation, and even has its own schools, careers, and TV networks. But while the foundation remains the same, the modern stock market is far more complex than its 17th century beginnings. Let's say a new coffee company wants to go public. They start by pitching the idea to major investors. If those investors see potential, they provide early funding and help the company launch its initial public offering, or IPO. Once on the public market, anyone from individual investors to giant institutions can buy shares. Buying stock makes you a partial owner in the company. Your investment helps the company grow, and as it succeeds, more people want a piece of the action. As demand rises, so does the stock price. That's good news for both the company and early investors, whose shares now hold more value. But if confidence in the company fades because of poor performance, bad leadership, or negative news, investors start selling. As stocks are sold, prices drop. The company's market value falls, and investors can suffer significant losses. This cycle of rising and falling prices is driven by one powerful force: supply and demand. Stock prices react to a wide range of factors, from production costs and labor shifts to new laws, global trade policies, and even social media trends. A leadership change or a viral scandal can tank confidence overnight. Meanwhile, some investors sell simply to cash out or pursue other goals. These constant shifts create day-to-day noise in the market, making companies seem more or less valuable than they really are. In the market, perception is power. If investors think a company is losing value, their panic can make it true. This emotional roller coaster is why the stock market can trigger both economic booms and financial crashes. It's also why most financial experts recommend long-term investing over trying to get rich quick. The good news? You don't have to be wealthy or work on Wall Street to participate. Thanks to the internet, everyday people can invest just like the pros. With knowledge, patience, and the right tools, anyone can buy stocks, support businesses they believe in, and pursue financial freedom. The first step to building wealth in the stock market isn't perfect timing or insider knowledge. It's simply getting started. So, are you ready to get invested? Don't forget to subscribe for more investment insights. Thank you.